Marianne, the story yesterday seemed pretty straightforward. This China reopening was going to be a boon for travel companies, for markets overall, for demand for oil, and for Chinese companies, too. And now today, with some of these new restrictions, there seems to be a wrench thrown into that thesis. So where do we go from here?
Well, what we've been saying, as long as the Fed is raising rates, expect, volatility and even episodic volatility. We've had issues with China for the past few years. That has really disrupted supply chains. You're certainly seeing that in the technology sector. And really what we've been saying is that there's a tale of two markets. You have the growth part of the market, which is, tech and FANG. And we really feel that the valuations still have to come down. And so those stocks are at risk of coming down. And that's a large part of the market cap. So we think markets are going to stay under pressure. But the bull is already running. There are pockets of the market where we're seeing stocks near or at record all-time highs. We're seeing it in energy, industrials, materials, and in healthcare. So it really depends, I think, where you're invested in how you're going to feel about the markets.
When you look at the overall indices, the charts that we were just showing with just, the last few days of December, I mean, we can hardly call this episodic volatility. All three major averages were basically flatlining, if you can see it right there. So for anyone who is looking to invest during these final few days of the trading year, Marianne, where do they go?
Well, as I said, I think the value part of the market is really where you want to be. That's where the valuations are. And we think that's the leadership. Leadership always changes when you're in a bear market and you go into the next bull market. And that leadership shows up near the tail end of the bear market. And that's where you're seeing, energy stocks perform really well. In industrials, you're seeing defense stocks perform really well. You're seeing pharmaceutical stocks perform and metal stocks. So I think those are the pockets that you want to be in. Now, markets can stay volatile. We only have 3 trading days left in the market. So that's not a lot of time to position. There's not a lot of liquidity. But I think if you actually dollar cost average into the markets, by the time you're at this juncture next year, I actually think people are going to be happy as long as they don't own those growth stocks.
So, Kevin, on the fixed income side, it seems that it's still being driven by what the Fed will do in 2023, whether we're going to get these 325 basis point rate hikes and then a pause or a reversal. Where are you on all of that?
Kayla, we think that the Fed is looking for the opportunity to get their credibility back. And so we think that we're going to see the terminal Fed funds rate go to 5 to 5.25, and we're going to continue to see yields go up. That has been the big thing. The Treasury market has been pricing in a recession for the last month or two, and you saw yields come down significantly, while the credit markets have actually been very stable and have shown no sign of any, scarcity, or have not shown any signs of any credit problems. So the credit part of the market is saying that there's going to be growth. And so we expect yields to be higher and seeing the 10-year go back up towards that 4.25 area.